And welcome to the show.
All right, all right.
Jerry is in an undisclosed location. I'm sure if you guys have been watching this for a while, you know where he's at.
Undisclosed up here in Boston. We're in
Boston.
the middle of a nor'easter. For any of you
Yeah,
guys that don't know what that is, it's like a 3-day mini hurricane,
it's
and
awesome. You got your surfboard?
it's huge surf and super choppy, but the dog's loving it, so it's all good.
I don't know, something weird is going on with my lighting. I look like I'm in like a halo or something. It's weird. It's green. Maybe it's grow green. Anyway, yours looks fine. All right, well, let's rock and
Good,
roll, man. What do you
good.
got for us this week?
All right. It's kind of a light week for economic news, but a busy week for sure. So we're going to look at what happened this week. Tariff price hikes are imminent. We'll look at a couple of headlines and then what industry groups we can expect to get hit the worst. And then on Wednesday, we had what's called a failed bond auction. We'll talk about that a little bit. The bonus chart is the dollar, very important with respect to the iFund and the TSP fund charts. So last Friday, actually, Moody's is the third credit rating agency over the last 20 years to downgrade U.S. credit. And then on Tuesday, they downgraded Fannie Mae and Freddie Mac. So there are some analysts that say, it's pretty inconsequential. There are other analysts that say that, it's another big indicator that the U.S. is going into recession here sometime soon. So a lot of argument whether or not it really matters. So we'll see what happens with that. But the S&P was up basically flat, was up 0.09% on Monday. Tuesday, no significant economic data, but there were speeches from pretty much all the Fed governors. S&P was down 0.39%. Then on Wednesday, we got the 30-year mortgage rate was up to 6.92% from 6.86% last week, and new applications fell 5.1% after they had risen 1.1% last week, and the week before that, I think they were up 11%. So we'll talk about it on the failed bond auction part, but it certainly looks like rates are continuing higher. The tax bill passed in the House of Representatives, so that's on its way to the Senate. That's going to be a big deal. That happened on Wednesday. The bond auction happened on Wednesday, and the S&P was down 1.61%. Then on Thursday, we get initial jobless claims, pretty much flat, actually down, right? 227,000 versus 229,000 last week. So unemployment is going to be the last shoe to drop, and it is not dropping yet. The full week average job loss claims, rose to 231 from 230 last week. So the job picture is still very stable. And the S&P was down 0.4% on Thursday. Nothing really coming out on Friday. New home sales data, that's about it. But as of about 10 o'clock on Friday morning, the S&P is down about 1%. Okay, so tariff price hikes are definitely imminent. I got a couple of headlines. So tariffs trigger price hikes. Shoes, clothing, and toys are going to get more expensive this summer. Everybody's already talking about Christmas. Can retailers eat tariffs without price hikes? Walmart, Target, and Lowe's face pressure. And Walmart was kind of the big news last week, but why Walmart decided to say it would raise prices and risk Trump's fury. So what do we actually have to worry about as far as consumers and price hikes because of tariffs? So apparel and footwear, you're already seeing it in Ross and Decker Outdoor. They're looking for higher prices because of the tariffs. Toys and consumer goods, because most of them are made in China. Autos and auto parts, the 25% tariff on imported vehicles from Canada and Mexico is going to affect, the North American supply chain, and could definitely raise the price of a new car. In this case, they're talking about by 20 grand. Food and groceries, and a lot of this is specific to Canada and Mexico, but we get a lot of our food from there. So tariffs on imports from Canada and Mexico, a significant portion of U.S. food supplies, fruit and vegetables. Food's going to cost more this summer. Chocolate and coffee. because of tariffs in countries like Ecuador and the Ivory Coast, are big exporters of coffee and cocoa. Housing materials. So Canadian lumber, as much as the administration likes to say we don't need anything from Canada, we use a lot of their lumber in housing manufacturing, and so the cost of building materials is going up, and it's going to lead to higher home prices and higher renovation costs if you want to do things at Lowe's and Home Depot. Chinese electronics is going to be a big one, right? The impact of the cost of laptops, tablets, smartphones, all based on this increase of, they should go up by 25%. That'll vary depending on how this whole tariff thing with China plays out. And then alcohol and beverages, there was that tariff on European wine, which had come out early on in the tariff thing, and Mexican beer. So prices for imported beer and wine are expected to rise, impacting consumer choices. So all those things, gas is going down. That's about the only thing in the U.S. that's going to be going down this summer. Everything else is going up in price. All right, failed bond auction. So this was from a Barron's article that came out on the same day. So bond auctions generally don't get covered very much, but we talked about it in the email that went out with the newsletter last week. Was all about the price of bonds and if the rates go up and our ability to pay and all that. So this was kind of really the first shoe to drop. Coincidentally happened this week, since we just talked about it last week, but a sale of 20-year U.S. government bonds saw weak demand Wednesday, pushing the treasuries to new lows for the year as yields climb. So the price of bonds goes up when yields go down. So when interest rates or yield goes up, the price of the bond goes down. So Treasury Department sold $16 billion of newly issued 20-year bonds at 1 o'clock on Wednesday. That's $16 billion. The rough total that the U.S. has to roll over in 2025 is $7.2 trillion in long-term Treasury debt. And the Treasury sold $16 billion, which is a drop in the bucket. And they didn't get a very good price for it. So it's routine for the Treasury Department to borrow to fund the government. Yes, that's what it does. The auction, however, saw heightened interest as investors worried that increased uncertainty about U.S. economic policies would lead to less demand for treasuries, and their fears were spot on. The auction saw investors accept a yield of 5.047% on the 20-year note, compared with the past 6 auctions average of 4.613. So the higher the yield, right, the more investors who are going to buy treasuries want a higher yield, because that's their rate of return. The government wants to sell the treasuries for the lowest yield it can sell it at. So the last 6 auctions averaged 4.6%. This one went up to 5.05%, right? So it cost the government a lot more to sell those Treasury, those 20-year notes. This was the first time the Treasury sold a 20-year note with a rate over 5% since October 2023. Back in the pandemic, it could sell its 20-year debt at 1.22%. So basically 5x, right? It's costing the government 5x what it costs to sell treasuries back during COVID. Higher rates signal that demand is weak, as the Treasury has to entice investors with higher yield to buy U.S. debt. So this is a chart of the 20-year government bond yield. Okay, whether you're looking at a chart of the 10-year bond yield or the 20-year or the 30-year, the patterns are all generally the same, but the rates are a little bit different. But from a technical analysis perspective, it's really the pattern that matters. So this was the low in bond yields. So the high in price, it was the high in price of the F fund, and it's the high in price of bonds. That was back in 2020. We had a 1, 2, 3, 4, 5 Elliott wave count up here for a 1. You got an ABC correction for a 2. It certainly looks like we're on our way, right? 1, 2, 3, and it keeps going. The chart certainly implies that yield goes higher, which means the price of bonds goes down. And the big problem this week, why it's got everybody all concerned, is because we had a double top here, and then this week we definitely took out that double top. So the next time people are going to freak out is when we get up here, when we take out this high, because then there's they call it blue skies. It just keeps going higher. So it certainly looks like yields are going up, which is bad for credit cards, bad for car loans, mortgage rates, all of it. The other big one is the dollar. So the dollar, super important for the I fund, and that's going to be the last chart. But if you guys remember, 2022 was a pretty tough year for stocks, right? As the dollar goes up, it's a headwind for stocks. When the dollar's going down, it's a tailwind for stocks. Basically meaning when the dollar's going up, it's not every day, and it kind of depends on the market environment. But in 2022, as the dollar was rising, the stock market's falling. In 23, the dollar's falling, the stock market's rising, right? So where we are right now, we've been in this support level at right around 100. Okay. And that's going back to the middle of 2023. So over the past couple of months, we're churning right on that 100 line. And so if it resolves, now every time it's hit there, right, it's gone higher. So if it ultimately resolves to the upside, like it has done all these times, if the dollar starts moving higher from here, the I fund goes down. If the dollar breaks support, right, this support channel, and we close down here somewhere, it likely keeps going and the I fund skyrockets. Okay. So that the last chart was a little bit of a zoomed in. This is a little bit of a kind of zoomed out, right? So it's a weekly chart, and here we are in 2008, right? That was the low. That was a decades long low for the dollar. And ever since then, we have higher lows, right? So the dollar is in an uptrend on a long-term basis. It's not acting too much different than it did all these other times, right? You get a spike, a high, a pullback, a double top or a little bit lower, comes back, but the ultimate low of that cycle still stayed above this low, right? So we get the same kind of thing here, a high, a little bit lower high, but we still have higher lows. So to have a high here and a lower high might not be that big a deal, right? We might get support here, right? And the dollar keeps going because that would be consistent with the longer term trend. If that happens, with the US CNS funds will go back to outperforming the I fund. This is really important what happens right there. If it breaks down, the I fund continues to outperform. If it finds support there and breaks to the upside, the CNS funds are back in business. Okay. So this is the same chart that we looked at first, and this is the I fund overlaid on the dollar. Okay. So when the dollar is going up, the I fund is going down. And there's a much better relationship between the dollar and the I fund versus the dollar and the C fund or the dollar and the S fund. Generally, and it's not day for day, but generally, when the dollar is going up, the I fund is going down. When the dollar is going down, the I fund is going up. Okay, and you can see it, dollar up, I fund down, dollar down, I fund up, right, all the way along. So here we had dollar down, I fund up, right? We had this spike down, but generally dollar down, I fund up. Okay. if this resolves to the downside, iFund keeps going up. If this resolves to the upside, iFund comes down. So where we are right now is critical. And I think we did the trend line, long-term trend line of the I fund versus the C fund, and we're right at that upper edge. So there's all kinds of different analytical ways you can look at this, but what happens right here is going to be really important. What's kind of interesting is that we had 1, 2, 3, 4 weeks where the dollar went higher, but the I fund also went higher. Right? We should have expected some kind of pullback in the I fund back here that went along when the dollar was rallying, but we didn't get it. So it's just showing the strength in the I fund to continue higher even when the dollar is rallying a little bit. So again, I wouldn't want to guess which way it goes, but once we get a breakout from here, we're going to know whether the I fund is going to continue to outperform or the C fund is going to be back in the driver's seat. Okay, TSP fund charts. So this is as of Thursday's close. Who knows how the market closes today? It's down 1% right now. So, if it closes there, we're somewhere in starting to fill that gap. But this is a weekly chart of the C fund. This is the 20-week moving average line and the relative strength indicator. And so each one of these ticks is 1 week of price movement. And so 2 weeks ago, we gapped up and closed above that. Well, this is the gap up, closed above that 20-week moving average line, right? Relative strength on the weekly basis got above 50. And so only good things happen, right? When we get above that 20-week moving average line, it tends to be long rally periods. So it's a good idea to be in the stock funds when price is above that 20-week moving average line and relative strength is above 50. And that's where we are right now. So there's no way of knowing, right? If we get a pullback to that rising 20-week moving average line, get support there and keep on going, that's absolutely a possibility. There's just more risk in the market if price is below that 20-week moving average line, and especially if relative strength is below 50. S fund had a little bit of a tougher week this week, and it's down even more today. So very likely that it'll come down to support there at its 20-week moving average line. And it's the same kind of thing. You really need to be careful being in the stock funds, or in this case, the S fund, if price gets back below its 20-week moving average line. I fund stronger than the other ones, but potentially starting to peter out. I don't know. It's going to depend on what the dollar does. This was obviously a huge move off the bottom. 1, 2, 3, 4, 5, 6, 7 straight weeks up. Obviously, the first week up was the strongest, and the momentum behind it has started to wane over the weeks. But if we get a pullback in the I fund to that rising 20-week moving average line, and it gets support there and breaks to the upside, that would be a great time to get into the I fund, especially if it was happening as the dollar was, breaking down through that 100 level. And the F fund, again, it's really the most important chart, because what happens with bonds, if rates go up, the stocks and bonds go down, just like in 2022, it's very likely that stocks go down also. So this is what the F fund looks like. The actual F fund numbers are here. But again, we've been talking about this. We build these charts in stockcharts.com so that you guys can have the actual TSP numbers on the side. But the index, the TSP funds themselves track the index. The TSP does, the dividends get reinvested. So the chart looks a little bit different than the actual index. So if we looked at the index of the F fund, it looks like that, right? Where this looks like a pretty strong recovery rally. So in terms of price in your TSP account, yes, the trend is higher, but the actual index has been basically flat since 2023. And the big worry is this head and shoulders topping pattern. So you have a left shoulder, a head, and a right shoulder. If support at this neckline gets broken, it's very likely that the F fund continues down, and theoretically it goes down that same magnitude, right? So you have a one move down, a consolidation, and another move down the same length as the first one. That's how you get the ABC correction. So if that happens, it's a big move down for bonds, and a spike, a huge move higher in interest rates, and the stock funds cannot continue to move higher in an environment where interest rates are going up like that. So there's all kinds of potential, and this is a big one because we are very close to breaking that neckline. And the G fund continues up and to the right. So the fear and anxiety and everything else that's going to be going on this summer doesn't mean the market's going to crash by any means, but there's a lot in here if you want to have a sense of where the market is likely to go. This is not a time to just set it and forget it and go on vacation. If you are, do it in the G fund.
If you do, go to the G fund. Yeah, like Jerry just said. Yeah, I think the uncertainty is the part that really is freaking people out, and that's understandable, right? And so you guys, if you watch this every week, you're looking at those charts. Sometimes we do get a little bit in the weeds, but by far the simplest thing you can do is what Jerry's showing in those last few slides, right? 20-week moving average, RSI. Use those two tools. If you're below the 20-week or 200-week, I'm sorry, I forget.
20-week.
Yeah, 20-week. It can be that simple. It's not going to be as you're not going to get in and out on the highs and the lows, perfectly or whatever. But it can be that simple. So that using the charts like that, even if you're not a big chart person, it just it enables you to just push out all the noise, right?
Yeah, that's the value of technical analysis, especially in something like this summer, because you're going to feel the anxiety of higher consumer prices. And that feeling is going to be like, well, the market must be going to go down because I feel anxious. Therefore, the market's going to be going down. And that's not necessarily the case. Right. Whenever the bottom is going to be the most anxious people are going to be.
Yeah, that's how it works. That's like the breaking point when everybody's just completely just over it, and all of a sudden, everybody starts buying again. All right, guys, if you have questions, put them in the comment section wherever you find these videos. And if you don't have a comment section, you can always email us, support@growmytsp.com. Hope you guys are having a great Memorial Day weekend, and be safe. We will see you guys next week.
All right.